The year was 1999. The world was worried about the Y2K bug. The internet was still a new and curious thing for most people in India. In the stock market, technology stocks were the talk of the town. But amidst this noise, a new story was quietly being written in the Indian banking sector. Private banks were starting to challenge the old, established public sector banks. They were bringing in new technology, better customer service, and a fresh way of thinking. It was a time of great change and opportunity for those who could see the future. The Indian economy was just beginning to open up and show its true potential to the world. Imagine a small investor back then, someone with just 10,000 rupees to spare. This was not a large sum of money, even at that time. It was the kind of money one might save for a small family expense or a minor luxury. Most people would have either spent it or put it in a safe fixed deposit, earning a small but predictable return. The stock market seemed like a casino to many, a place for gamblers and big players. The idea of putting hard-earned money into a single company, especially a relatively new private bank, would have seemed very risky to the average person. But investing is about seeing what others don't. Let us say this investor decided to take a chance. They looked past the flashy tech stocks and the old, slow government banks. They saw something in HDFC Bank. Perhaps it was the professional management, the clear vision, or the focus on quality. In early 1999, the share price of HDFC Bank was around 40 rupees. With an investment of 10,000 rupees, our brave investor could have bought approximately 250 shares of the bank. This single decision, this small act of faith in India's growth story, was the first step on an incredible journey. It was a bet, not just on a bank, but on the future of the Indian middle class and the entire economy. At that moment, the purchase of 250 shares would have seemed insignificant. There were no immediate fireworks or dramatic gains. The share certificate would have been a simple piece of paper, filed away and perhaps forgotten for a while. This is often how the greatest wealth creation stories begin, not with a bang, but with a quiet, well-thought-out decision. The investor's job was now to do the hardest thing in the market: nothing. They had to sit tight, ignore the daily news, and let the company do its work. This initial investment was a seed, planted in the fertile ground of a growing economy. Now, all it needed was time. The initial purchase of 250 shares was just the beginning. The real magic in long-term investing often comes from corporate actions like stock splits and bonus issues. These are gifts that a growing company gives to its shareholders. A stock split is when a company divides its existing shares into multiple shares to boost liquidity. A bonus issue is when a company gives additional shares to its existing shareholders for free. For our HDFC Bank investor, these events were like a powerful tailwind, dramatically increasing the number of shares they owned over the years without any additional investment. It is the company's way of rewarding the faith of its long-term partners. Let's track how the share count multiplied. First, in July 2011, HDFC Bank announced a stock split. The face value of each share was changed from 10 rupees to 2 rupees. This means for every one share an investor held, they now had 5 shares. So our investors' 250 shares instantly became 1,250 shares. The value of the investment remained the same at that moment, but the number of shares increased 5-fold. This made the shares more affordable for small retail investors, increasing participation and trading volume, which is healthy for any stock. It was the first major multiplication event for our patient investor. The story doesn't end there. HDFC Bank continued to reward its shareholders. In 2019, the bank announced another stock split, this time changing the face value from 2 rupees to 1 rupee. This meant every shareholder received 2 shares for every 1 share they held. Our investors' holding of 1,250 shares now doubled to 2,500 shares. Think about this incredible journey. The initial 250 shares, bought with just 10,000 rupees, had now grown to 2,500 shares. This happened without the investor putting in a single extra rupee. This is the power of being a part owner in a business that is growing and wants to share its success. This process of share multiplication is a crucial lesson. Many investors only focus on the price of a stock. They buy and sell based on daily price movements. But the truly wise investor understands that the number of shares you own is just as important, if not more so. By holding on through splits and bonuses, you are increasing your stake in the business. It's like owning a small plot of land that magically expands over time. The initial 250 shares were a small seed, but through these corporate actions, they grew into a mighty forest of 2,500 shares, ready to bear fruit. Now we come to the most exciting part, calculating the value of this investment today. After 25 years of patience, after holding through market crashes and euphoric bull runs, what is the reward? We saw how the initial 250 shares grew into a substantial holding of 2,500 shares. To find the current market value, we simply need to multiply this number by the current share price of HDFC Bank. As of mid-2024, after its merger with HDFC Limited, the share price of HDFC Bank has been trading at strong levels. For our calculation, let's assume a conservative price of around 1,600 rupees per share. This is a realistic figure reflecting its market position. The math is simple, but staggering. If we multiply the 2,500 shares by the price of 1,600 rupees per share, the total value comes to an incredible 40 lakhs. From an initial investment of just 10,000 rupees, the value has grown to 40 lakhs. This is a return of 400 times the original investment. This is the kind of wealth creation that changes lives. It can fund a child's education, a comfortable retirement, or the down payment for a dream home. And it all started with a small amount of money and a very large amount of patience. This is the power of compounding in its full glory. But the story of the returns does not end with the share price appreciation. A great company doesn't just grow in value, it also shares its profits with its owners, the shareholders. This is done through dividends. HDFC Bank has been a consistent dividend-paying company throughout its history. While the dividend per share might seem small each year, when you own 2,500 shares, it adds up to a significant amount. Over 25 years, the cumulative dividends received would have been a very substantial sum, adding many more lakhs to the total return. This is passive income, money earned simply by being a long-term owner of a quality business. If our investor had been truly smart, they would have reinvested these dividends back into buying more shares of HDFC Bank. This strategy, known as a dividend reinvestment plan, accelerates the power of compounding even further. Each dividend payment buys more shares, which then earn more dividends in the future, creating a virtuous cycle of wealth growth. While our calculation of 40 lakhs is already mind-boggling, a strategy of reinvesting dividends would have pushed the final corpus even higher. It turns a one-time investment into a self-sustaining wealth-generating machine, working for you year after year. The phenomenal growth of HDFC Bank was not a matter of luck. It was built on a solid foundation of strong principles and excellent execution. One of the most critical factors behind its success has been its unwavering focus on quality and prudent management. From its early days, the bank was led by visionary leaders like Aditya Puri, who built a culture of discipline and risk management. Unlike some rivals who chased aggressive growth by giving out risky loans, HDFC Bank always prioritized the quality of its loan book. This meant lower non-performing assets, or NPAs, and a more stable, reliable business, especially during economic downturns when other banks struggled. Another key to its success was its ability to innovate and adapt. HDFC Bank was a pioneer in using technology to improve customer service and efficiency. They embraced digital banking, mobile banking, and other technological advancements much faster than their public sector counterparts. This allowed them to attract a growing base of young, urban, and tech-savvy customers. They understood that banking was no longer just about brick-and-mortar branches. It was about providing convenient and seamless services to customers wherever they were. This forward-thinking approach helped them capture a massive market share over the years. The bank's growth was also perfectly timed with the growth of the Indian economy itself. As India's middle class expanded, so did the demand for banking services like home loans, car loans, credit cards, and personal loans. HDFC Bank was perfectly positioned to meet this demand. They built a powerful brand that stood for trust, reliability, and professionalism. When people thought of a private bank they could trust with their life savings, HDFC Bank was often the first name that came to mind. This brand equity is an invaluable asset that takes decades to build and is a major reason for its sustained success. Finally, the merger with its parent company, HDFC Limited, in 2023 was a masterstroke. This created a financial behemoth with an unparalleled product portfolio, combining the best of banking and housing finance under one roof. This move is expected to unlock massive synergies and create a cross-selling powerhouse, further solidifying its market leadership for the decades to come. The management has consistently demonstrated an ability to think long-term and make bold strategic moves that create immense value for shareholders. It's this combination of prudent risk management, technological innovation, brand power, and strategic vision that made HDFC Bank a true winner. The incredible story of the 10,000 rupee investment holds profound lessons for every investor, big or small. The most important lesson is perhaps the simplest. It is time in the market, not timing the market, that creates wealth. Our hypothetical investor did not try to predict the market's daily moves. They did not sell during the 2000 dot-com bust, the 2008 global financial crisis, or the 2020 COVID-19 pandemic. They simply bought a great business and held on. Trying to time the market is a fool's game. Even the best experts cannot predict short-term movements. Real wealth is built by staying invested through good times and bad, letting the power of the business work for you. Another crucial lesson is that you do not need a large amount of capital to start your investing journey. A sum of 10,000 rupees was a modest amount, but when invested in the right company and held for the long term, it grew into a fortune. Many people delay investing because they feel they don't have enough money. This is a mistake. The key is to start early, even with a small amount, and invest regularly. A small seed, given enough time and the right conditions, can grow into a giant banyan tree. The power of compounding works best over long periods, so the sooner you start, the better. This case also highlights the importance of identifying compounder stocks. These are high-quality companies with strong management, a sustainable competitive advantage, and a large runway for growth. They are businesses that can consistently grow their earnings and profits year after year. Finding and investing in such companies is the holy grail of investing. It requires research and a focus on business fundamentals, not on market noise or speculative tips. Instead of chasing the latest hot stock, look for businesses with a long track record of excellence and a clear vision for the future, just like HDFC Bank had in 1999. Finally, the story teaches us to ignore the short-term noise. Over 25 years, there would have been countless news headlines, analyst reports, and market gurus predicting doom or euphoria. There would have been periods when the stock went down or stayed flat for months. A nervous investor would have sold out of fear or boredom. Our successful investor, however, focused on the long-term picture. They trusted the management and the fundamental strength of the business. Patience and conviction are the two most underrated virtues in the stock market. They are the true keys to unlocking extraordinary returns. Let's talk more about the engine that powered this entire journey: compounding. Albert Einstein supposedly called it the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. Compounding is the process where the returns you earn on an investment start to generate their own returns. It's a snowball effect. In the early years, the growth seems slow and unimpressive. But over time, as the base grows larger, the growth becomes explosive and exponential. The HDFC Bank story is a perfect textbook example of this principle in action. The real magic didn't happen in the first 5 or even 10 years. Think about the growth of the 10,000 rupee investment. In the initial years, a 20% return would have been just 2,000 rupees. It's a good return, but not life-changing. However, fast forward 20 years. Let's say the investment has grown to 20 lakh rupees. Now, a 20% return in a single year is 4 lakh rupees. That is more than the total value of the investment for many of the early years. This is the non-linear, explosive nature of compounding. The biggest gains come in the later stages of the investment horizon. This is why it is so critical to stay invested for the long term, to allow the compounding engine to reach its maximum speed. The dual forces of share price appreciation and reinvested dividends create a powerful compounding machine. The price of the stock goes up as the business grows and becomes more profitable. This increases the value of your capital. At the same time, the company shares its profits with you through dividends. If you reinvest those dividends, you buy more shares. These new shares then appreciate in value and also earn their own dividends. It's a cycle that feeds on itself, accelerating your wealth creation far beyond what simple price appreciation alone could achieve. It is the closest thing to a financial perpetual motion machine. The biggest mistake an investor can make is to interrupt this compounding process. Every time you sell a good stock, you reset the clock. You not only have to pay taxes on your gains, but you also lose the future compounding potential of that investment. The old market saying, "Let your winners run," is rooted in this wisdom. When you find a great company like HDFC Bank, your job is to hold on tight and let the management do its work. The temptation to book profits after a stock has doubled or tripled is immense, but selling a long-term winner early is often the most expensive financial mistake you can make. The story of HDFC Bank is inspiring, but it is a story from the past. The crucial question for investors today is, how do we find the next HDFC Bank? The world has changed. New sectors and new technologies are emerging. The next multi-bagger may not come from banking. It could come from artificial intelligence, renewable energy, healthcare, or some other field we are not even thinking about today. However, the fundamental principles of identifying a great investment remain the same. The key is to look for the same qualities that made HDFC Bank a winner, but in the context of the future economy. First, look for a large and growing market opportunity. HDFC Bank rode the wave of India's growing economy and the formalization of its financial sector. The next big winner will be a company that is catering to a massive, untapped market. Think about the big problems and needs of the future. Who is solving them? It could be a company making electric vehicle components, a firm specializing in genomic medicine, or a platform for digital education. The size of the opportunity is the primary filter. A great company in a dying industry can't create wealth for you. Second, focus relentlessly on the quality of the management. A business is only as good as the people who run it. Look for management teams that are honest, competent, and have a clear long-term vision. Do they have skin in the game, meaning do they own a significant stake in the company themselves? Do they have a track record of excellent execution and prudent capital allocation? Read their annual reports, listen to their conference calls, and try to understand their philosophy. A great jockey can win a race even on a decent horse, but a bad jockey will lose even on the best horse. Finally, look for a business with a strong competitive advantage, or what Warren Buffett calls a moat. This is something that protects the company from competition and allows it to earn high profits for a long time. For HDFC Bank, its moat was its brand, its low cost of funds, and its technological edge. For a future company, the moat could be a strong patent, a powerful network effect, a superior technology, or a beloved brand. Your job as an investor is to be a business analyst first and a stock market analyst second. Find these future giants, invest with conviction, and then have the patience to let their stories unfold. The next 4 crore rupee story is out there, waiting to be found.